Good evening, everyone. Thank you so much for joining the second session of our partnership with MASECO. Tonight, we'll be discussing delving deeper, including mortgages, pensions, and everything you may have missed from the previous session, but you did not come to hear me talk. So I will pass along to our lovely experts, Daniel and George, who will talk us through these very complex issues. With that, take it away.
Todd, have you turned us on? Can't tell if you can hear me. I can't hear Dan.
Come up and start your video. I've got you now.
Yeah, I've hit all the buttons. There we go. I see you now. Brilliant. All right. Well, I'm just going to assume that this is going to come up, and we're going to pretend there's a disembodied voice. Hello, whoever's out there. Good to see everybody again. Well, I missed you the first time because I was on holiday and Dan had to do all the heavy lifting himself. And this time you get both of us for whoever's out there. Hopefully, we know this isn't a really interactive format, but hopefully we'll have some ability to do a little interaction. One of the things we'd love to know, I've put in the chat if you're able to, we'd love to know, were you at the first one? So we know there's a bunch of people here. We don't know exactly what the overlap was. And if most of you are at the first one, we'll sort of skip over some bits a little bit. If most of you weren't at the first one, we'll probably spend a little bit more time. So as we're getting started, maybe pop into the chat. Yeah, this is your first one, or no, I was at the first one, or whatever. That'll be awesome. And your feedback after this is really, really helpful. We're making this up as we go along. So we're sitting down with Greta and Todd and the team at UCT and saying, hey, what might be helpful to, the community that we are trying to find different ways to support, dating back to the gala, and now just try and find other ways to support. And, one of the key things, of course, is we have some information, some knowledge that's really useful for this community. And so we're trying to find ways to share that. This will be the second virtual one. We'll do an in-person one in January. So we'll continue to sort of figure this out, but your feedback could be really, really helpful. And with that, we're going to get started. Dan and I are going to sort of ham and egg this together, try and make it a little more conversational, a little less presentational, but give you a decent understanding about some relatively sophisticated topics, but they come up so often that we thought a special session just to talk about a lot of sort of mortgage and property related stuff, a lot of sort of pension retirement related stuff would be really helpful. It's a lot to cover, so we don't want to go so fast and like go over your heads, but we also want to just make sure you've at least heard some of these important topics. So why don't we kick it off, Dan?
Yeah, and just to let you know, George, so we've got a mixture here of people actually attending for the first session. We've got a few that are actually coming back for the second one. Hopefully you found the first one useful. So what we'll do is actually just give a very sort of brief recap of just who you're actually listening to tonight, and just about more generally MASECO as a firm. So I'll kick things off, very, very brief background. So I'm Dan Keeley, a wealth manager at MASECO Private Wealth. I've been with the firm for just over 7 years now, directly dealing with all things US, UK related in the private client space. George and I work very closely together, dealing with everything from the investment management side of things, helping people invest their money on their behalf, making sure first and foremost it's tax efficient from US, UK. It's looking at the financial planning, which is some of the topics we're going to actually cover today. And then really it's the looking at things like relationship management. So a lot of the topics we're going to discuss today are going to be very tax heavy or tax related. And so we'll just announce up front that we are tax aware, we are not tax advisors, but we have to obviously understand the interplay to be able to do our job properly. So we'll just get that caveat in straight away, George, I think. I'll just give you a chance to just give a brief.
I won't do my bio. So Dan and I do the same job. I'm just a little bit older. And I think the important part of my bio is that I've been very involved with the alumni community in the UK for a long time, specifically with the Brown University group where I went, and then through them in partnership with lots of other schools over time, sort of ad hoc. So when we connected with UCT leadership and had an opportunity to do something in a really structured way with an alumni community, that really resonated. So that's the important bit in terms of why this partnership has come together and where we're going with it.
Exactly that. But just as a very brief overview of the agenda today. So what we're looking to do is we've really done sort of the brief introduction to MASECO. We're a specialist US UK wealth manager. What we want to do is do a little bit of a recap of the last session, but I can really do that now, to be honest. And George has already sort of started this. In that first session, what we were looking to do was really to give you a broad overview of some basic do's and don'ts. Now, in the US UK space, there are countless. And so it's hard to get that all down into sort of a 1 hour session. And so I don't know if you guys can see on the chat there, but Todd has also noted that the first session was actually recorded. And so please do feel to go back and actually listen to that. But what we are doing as well is at the end of this, you can get our contact details and just reach out. I've had a number of conversations with the UC Trust guys, the people that have been at the first session, to then just get in touch and say, look, we've covered these topics, but I want to hear more about them, about my own specific scenario. Can we just set up a call? And we want to do the same for today. So we'll tick through this presentation. You see at the bottom there, it says any questions. Anytime George and I do these presentations, usually it makes sense to just ask questions as we go along. And so please do feel free to do that there. But what you can see is really what we wanted to try and focus on is some of the deeper topics now. So as George said, so property mortgages, but also the US UK treatment of pensions. So let's just,
Let me just say, look, this call is for all of you.
yeah,
So
exactly.
if we run out of time, it's okay if we've done so because we were answering questions that you had along the way. We want to make sure you at least heard all the important stuff, so we'll skip through if we have to, but please do let us know what you want to hear about. This is sort of your session.
Exactly that. Probably don't need to go too much into MASECO there.
I'll do MASECO in 30 seconds. We've been around 15 plus years, founded specifically to look after Americans in the UK. So this is what the company is founded to do. And by most metrics, we are the largest provider in this space, either by the number of wealth managers or the amount of assets focused on this, whatever, which just means we really know what we're doing and we've got a lot of capability in the space. And so we can offer some of that insight to you.
Exactly that. We'll go over to these bits. George, do you want to just give a recap because you weren't on the last call? We'll
Exactly.
give you the opportunity to sum up what we're looking at here. Oh,
yeah, I'll do your hour call in a minute. So essentially, for those that weren't on the call last time, what we normally cover in the sort of the basic do's and don'ts session is a recognition that property is a huge part of what people care about and have money invested in. And note that there's some beneficial things about it, like it produces a yield and it can grow your capital. That's great. But there's some real pitfalls, some of which are just standard for anyone owning property, like it's not liquid and it's hard to get out of sometimes, but some of which can be really specific to being a US UK connected person. And so the examples about Boris Johnson and as an accidental American, what he went through, some of the examples around paying off a mortgage, which Dan would have just flagged last time. We're going to go to a lot more detail this time, are just some pitfalls we wanted to flag last time, and we'll spend more time on those in this session.
Exactly that. So as George just mentioned, of course, when you're looking at purchasing property, the usual considerations are going to comply. So how much you should put down in terms of what the deposit amount is. Of course, the more you put down, usually the better terms you're going to get on the mortgage. So that's one point. Things like, well, what type of mortgage should I secure? Is it interest only? If you're paying back principal? Again, it's going to be completely dependent on your circumstances, what you can afford to borrow, what you can afford to actually put down on. And then really just things like, have you considered stamp duty, land tax, conveyancing fees, which in the UK can start, if depending on the actual purchase value of the property, can start getting pretty high and heavy. And so it's just one consideration you need to make. Likewise, if you are investing in property for an investment purpose, so whether or not it's not your primary residence, but instead you're actually purchasing property to then rent out or things like that, you've then got to be considerate of the extra taxes that you need to pay with stamp duty, land tax and things like that. So these are just a few things to just be considerate of, and we covered a number of these in the last session. But
and
we want to talk.
Please note the topic. This is UK property as a US taxpayer. There's different nuance if we're talking about property in the US, but just make sure we know.
Correct. Exactly that. So which is it, the alumni space here, living in the UK. And so what we want to talk about today is people in that situation where you are here, you are resident, you are looking to purchase a property. What should we be looking out for from a US UK perspective? And we've listed off a few here. So the first one is looking at, okay, if you've moved to the UK and you've earned money that has been held offshore, which means it hasn't already been subject to UK taxes, how will HMRC categorize that if you were to bring it across to the UK? Is it considered clean from a UK perspective? And what I mean by that is, for those that have, and again, I'm going to throw a few terms here, and this will impact a number of people on this call. But there's also changes to these rules coming up in April. But as the rules currently stand, there is something called the remittance basis of taxation, whereby in the first 7 UK tax years, you can hold assets offshore and they will not come into scope of UK taxes if they stay offshore. If they were to be brought into the UK, there may be tax implications of doing so. And we won't go into the technicalities, but they will look at things like the ordering rules of, okay, is it income you're actually bringing across in terms of like dividends or interest that you've earned offshore that hasn't been subject to UK taxes? Is it gains? Have you actually sold assets, but again, held the asset offshore and you haven't brought that into the UK? And so when you are looking at funding a UK property purchase, if you are looking to utilize funds that have been held offshore and haven't previously been taxed in the UK, you want to be aware of that before you actually remove any money across, because otherwise you could be hit with a tax bill that you was not expecting. And so again, this is working with a wealth manager. This is working with your tax accountants to understand, firstly, what is the sort of the categorization of your offshore income and gains, what your different accounts over there, and how that would be considered from a UK perspective. And so again, this will be very dependent on the individuals themselves and whether or not they have actually just held assets offshore. But this is just one consideration that you need to be thinking about there. Likewise, and I don't know if you want to add anything on that, George, but in terms of it's just
No, I think the important takeaway is if you're going to buy a property here and the money is not taxed UK money already from anywhere, then you need to have a conversation.
Exactly that. And then not only that, specifically when we are referring to US taxpayers, and I mentioned this in the last call, but it's the way that individuals are taxed in the UK when it comes to things like property is going to be different compared to in the US, as George mentioned. A useful example is the primary residence relief. So individuals in the UK, Americans included, if you own UK property and it is considered your main residence, when you actually come to sell that asset, and it's made again, there are no capital gains taxes due in the UK, which is fantastic from a UK perspective. The thing you need to, for US taxpayers though, is of course the IRS is going to follow you regardless of where you reside. And in the US, that's not the case. Instead, what you have is a $250,000 capital gains tax allowance when it comes to property. But anything above that amount, so say you sold your property in the UK and you'd actually made $500,000 worth of gain, which if you've held the property for a number of years, that could very well be the case. Anything over that $250,000 threshold is going to be taxed at capital gains taxes in the US. So that's important, a sort of distinction between the two jurisdictions there. And so that sort of ties me into things like mixed nationality couples. Because again, when George and I are having conversations with clients, if you have mixed nationality couples where one of the spouses isn't a US taxpayer, then there should be a further conversation about, okay, well, how should we own this property? Should it be only in the UK individual's name, the UK only a national in his name? Because of course, if that was the case, all of that gain would be completely tax-free. You don't have to worry about the US tax implications because they're not actually owning the property. Now, this is just one of the considerations.
Yeah, and just to go through that a little bit. First of all, obviously there are implications as a U.S. Filer if you're filing individually or if you're trying to file jointly, et cetera, between a mixed nationality couple, all this kind of stuff. More importantly, it's really just worth parenthetically noting the question we get back often with this type of planning conversation, and we're not pushing anyone to do anything, but we're just showing options. They get concerned sometimes about, a marriage falling apart and the assets being all in the name of one person versus another, and is that a problem, an issue, and so forth. We'll do a whole separate session maybe on family law differences in the UK versus the US, and depending on which state in the US is dramatically different. But as a parenthetical point, generally UK divorce law starts with 50-50, and it starts with all the assets. Doesn't matter in whose name it is. So the asset could be in my name, and I run off with the pool boy. It doesn't really matter. All the assets of the marriage, regardless of how it's titled, get thrown into the pot and considered by the court. So that is not one of the reasons not to do this, but we know it comes up a lot.
Exactly that. And in some situations, you don't have a mixed nationality couple. And so you would then just be, it would just be the two Americans. But again, you got to think in that situation, you can, each individual US taxpayer gets $250,000 as the tax-free amount. And so it's $500,000 for the married couple, sort of with the UK property. Yep. It's just another note in there. And the other one as well, so we've spoken about sort of ownership structure. The other note is actually borrowing money. So for the vast majority of people, when you are looking to actually purchase a property, you're going to have to typically borrow borrow money in the funds in the way of a mortgage. And what we wanted to sort of dig into the details today was what I'd sort of raised in last session around phantom gains on mortgages for US taxpayers, because this is one of these, how would you describe it? Intricacies of the US UK space, where it is so painful, and there are situations where it is completely out of the blue for a number of taxpayers. It's painful because it's a dry tax charge. It's only on paper why the IRS is actually considering this a gain. And so we wanted to just flag this first and foremost, so you're aware of it, and then talk about potential ways of mitigating it if possible. And again, this is where you'd have to work with a tax accountant.
As he goes to the next slide to go into the details, just a couple of define some terms there. So a dry tax charge, meaning that usually if you sell something and you have proceeds, you can set aside some of the proceeds to pay your tax. In this case, since you're not selling anything, you don't have any proceeds. There's no liquidity event that's generating the tax charge. So not only do you have the tax charge, you don't have any cash to pay for it from the event that's generating the tax charge.
Exactly that. And so I just wanted to just walk you through sort of a worked example here, and I'm conscious there's quite a bit of wording on the screen here. So
this is mostly so you can read it in the background while we talk through it, and because the numbers are helpful to see, but it's not as complicated as it looks.
No, exactly. And it's more to just say, so I'm just to work through an example. So typical scenario where you've got a US taxpayer, they're living in the UK, and they want to purchase a property. So they are looking to borrow some money. As an example here, they're borrowing £1 million to fund a UK property purchase. Now, the important point to note is, on the date of actually borrowing that money, what you need to be aware of is what is the FX rate between sterling and dollars on the date of actually borrowing, because the IRS is going to be aware of that. The reason, of course, is the IRS only care about everything in dollars terms. Likewise, HMRC care about things in sterling terms. And so just as an example, at this time, they're borrowing £1 million. And this was at a time where the GBP to USD FX rate was 1 to 2. So £1 was worth $2, straightforward. So borrowing essentially the equivalent of $2 million there. Just made this example up, but say a few years down the line, they've received an inheritance and they are saying, actually, do you know what? I'm tired of having debt. It gives me emotional stress. I want to pay this mortgage back. I'm going to do it all in one lump sum and not have a mortgage anymore. Pretty straightforward. You go, yeah, that probably makes sense. What you need to be aware of, though, is, of course, over time, what you're going to see is the FX rate fluctuating. And in a way where, say, dollar was to weaken, and this is the example here. So say that you first borrowed that $1 million when it was 1 to 2. Now it's then moved to 1 to 1.5. So one pound is worth $1.50. And so using the earlier example, that would now be, and you're actually paying back the mortgage. What the IRS will now argue is that this US taxpayer is actually only paying back 1.5 million, not the 2 million in which they borrowed. And they will say, hang on a minute, you've made a gain there, a gain of $500,000. And as we just said, it's only on paper. This is only based on the fact that only on the fact that you have the currency fluctuation there. The issue with that is because they will say, okay, you've made a gain. And that gain will actually be taxed, and not capital gains tax rates of up to 20% in the US. They will actually look to tax at your marginal income tax rate of up to 37%. So again, just working through this example, the IRS could actually generate $185,000 worth of tax revenue, which is sort of the 500,000 times the 35 income tax rate, just from this one transaction, which is only on paper. And so you can see now why this becomes so painful for certain individuals and certain taxpayers, because again, there is that you can't control the FX rates, and when you are looking to pay money back and things like this. And so wanted to just flag that, wanted to just give us sort of a worked example there.
Let me chime in on a couple of bits and pieces. So someone noticed the typo that we hadn't had time to correct, that it's actually a dollar strengthening rather than dollar weakening. You're technically correct. We hadn't finished update. We hadn't updated the slide to say that correctly, but the good catch. Someone's really reading and paying attention. Well done. We did. But the most important part is the fluctuation, of course, change regardless. That's one. But kudos to Greg for noticing that. The second point to make on the slide is, of course, this is regardless of why this is happening. So you don't have to have an inheritance. You could just be,
exactly,
selling the house to downsize, to upsize, to do it. It's about the full repayment of the mortgage that triggers this event, not why you're doing it. Just to clarify that piece as well. And the last piece to clarify is that it doesn't work both ways. So if
Greg is on there now, I can see Greg's comment.
So if you have a change, that means that from the IRS perspective, there's been a dollar gain in what you've paid back versus what you borrowed, you owe tax. But there's no phantom loss on the other side of this, so that produces a tax credit or anything like that. So it's a heads I win, tails you lose situation from the IRS, unfortunately.
Exactly that. And so then it's talking about, okay, well, what can you actually do? And now this is where it becomes a little bit of a gray area. And George, I'll let you talk through this one here, but.
Yeah, so this again is difficult for us to talk about because, again, we are not actually giving tax advice, blah, blah, blah. But obviously we work with clients who do have to take formal tax advice from lawyers and accountants around how to deal with this. And so we're sharing with you what we have seen people do. It's not what we can recommend that they do because we don't give this kind of advice. So here's an example. One Dan already talked about, which is, specifying not just who owns the house in terms of the deed, but the mortgage. That isn't always possible based on earnings profiles and other types of things, cash flow, et cetera. But we do work with some specialist mortgage brokers that can help find options that aren't just your local high street bank, that might be able to structure sort of a non-standard type of mortgage based on the asset value or the overall assets of the family or other types of things other than sort of normal earnings power. But that is sometimes a constraint depending on which spouse is the U.S. and non-U.S. spouse. Another one of the things that we should just be clear about is the reason this is an issue. It's the full repayment of the mortgage. That's what triggers this thing. You'll notice that if you have a mortgage where you pay down a bit each month, that's not triggering this issue because you're not paying off the full amount. You're just paying it down. You're paying interest and you're paying some principal month after month after month. And it's this concept, the concept of making regular mortgage payments, that doesn't trigger this event, that we've seen some advisors go to people who, we have shared clients and say, well, that's the way, if you have the excess cash, that's the way to solve this. So don't try and pay it off at once, pay it off over a year or two, making substantially in excess contributions if there aren't penalties in your mortgage for prepayments, and pay it down that way. And so you can show a history of mortgage payments paying it down. It becomes regular payments as opposed to a single payment, et cetera. This is a huge gray area. So some advisors will say there has to be at least 5, at least 10, at least 12. It needs to be over a 12-month period, more than that, less than that, et cetera. This is not written down anywhere. This is an interpretation that is made by various advisors in trying to help people through that process. But of course, to do this, you have to have a lot of excess money, right?
Yeah.
You need to have money somewhere to be able to pay this down in advance of you actually selling the house, if you're selling the house, or getting a new mortgage or what have you. So this is an option that we've seen happen. It doesn't work for everyone. But anyway, wanted to highlight both the problem and the fact that there are some solutions out there. The most important thing is to know it's a problem. And if you note down at the time that you've made the mortgage or taken out the mortgage, what the FX rate is, and at the time you're going to pay it back, you can see that it has not moved or has not moved against you, it's moved the other way, then you know that you don't have this problem, right? So that's as important to know.
Actually, we got a question coming through here, George. So does remortgaging trigger this at the end of a 2 or 5 year low rate period?
Right. So the short answer is it depends. If you have the same mortgage, but the rate is simply changing, I think most tax advisors would say, no, you haven't repaid the mortgage.
Yeah.
Simply the rate on the mortgage has changed. But quite often what people do is when that 2 or 5 year period ends, they go shopping for a new mortgage and may actually take out a new mortgage. And in which case, I think a lot of tax advisors would say, yeah, you got to make sure you're not triggering that problem.
And again, that'll all come down to sort of and where it is that grey area is completely depend on how that tax accountant would sort of view something like that. Just give us a second. Any more questions on that?
Yeah.
Okay, I couldn't see any other questions on that, so we'll move on there. What we next wanted to talk about was, of course, retirement accounts. I can see your lips move there, George. Were you about to add something on?
No, I think we answered Jonathan's question about fully, and I think we answered Greg's questions as well, and NM's questions. I think I'm just making sure we answered all the property questions before we go to the retirement accounts. There was one more about selling a property using proceeds to purchase another property. Does the 250 limit apply? So effectively, yes, it resets. So for each home that each time you own a home and sell it, for the new one, you get a new 250 limit. I think that's your question. Okay, let's go to retirement accounts.
Perfect. So what we wanted to cover here, and this is, again, I'll just do a very sort of brief recap, and I'm conscious we're at past now. So the whole point here is that the vast majority of those on this call will either have US pension assets before they moved to the UK, or they built up UK pension assets since being here. And then the plan is to move back in either direction. And so what we wanted to try and discuss today was really the interplay between the US and UK when it comes to pensions. Because of that point at the top, you can't port pensions. So unfortunately, we have this question constantly going, well, I've got these funds in my traditional IRA, my US retirement account. Can't I just bring them over here to my UK pension and just have it invested in that pension wrapper? That would be fantastic if it was the case, but you can't do that. And so the only way that you would be able to get funds or assets that are currently held in your pension is to take a distribution, to take money out of the pension wrapper and then try and get that into your UK pension wrapper as an example. But of course, you've then got contribution limits, and things like that. And so typically the best advice is to actually just keep them where they are. And the reason for that is the next point there about the US and UK tax treaty. So our understanding as non-tax professionals is the fact that pensions are going to be considered pensions in both jurisdictions. And what we mean by that is you're still going to benefit from that tax deferred growth within the pension wrapper. So there's no income taxes to pay on any of the income generated through sort of interest and dividends annually. You don't have to pay any capital gains taxes if you use to sell the underlying assets within the pension wrapper. There's no taxes when it's in there. You are only then going to pay taxes once you start taking distributions. And again, we're going to cover sort of the distributions from a traditional IRA or 401k in comparison, say, a Roth IRA as an example, but we'll come on to that in a moment. And so really, when we are looking at sort of further planning, the idea is to maintain your pensions and to leave the assets in there to grow as tax deferred for as long as possible. Once you get into retirement, what you want to then do is think about taking from cash first, then look at taking from your taxable investments. And at that point, then you look at, okay, I've got my UK pensions, I've got my US pensions, what should I be taking from there? And so again, this is that is really the structure when it comes to actually starting to draw from these further down the line.
As we get into this pension topic, again, I'll invite people to put it into the chat. Do you have a US pension a UK pension, or both? Just pepper us with a bunch of those things. I'd be interesting to know as we're talking through this. You can just US, UK, or both, and then we'll keep going through the relevant topics here.
Exactly that. And again, we're not going to be covering it too much in this particular session here, but in a further session, and we might actually just put this on the next one, is digging into things like state pensions and social security payments, and talking about things like the windfall elimination provision, which is essentially looking at equalizing pensions across the two jurisdictions. But again, we're just going to flag it here today, but we want to focus on the rest of the pensions for the moment.
The main reason for that is that those topics can get quite technical, but the amounts are quite small. So for most people, you know,
exactly,
the idea that they're going to be able to live on their state pension from either country is unlikely. And so most of the planning that we're doing with people is around their own pensions that they have procured in their working lives. But it's an important topic, and so we will at some point find a way to go into.
Exactly that. And Jonathan, I can see your questions in there about the FBARs and about pension administrators that can have the assets rather than sterling. The answer, we will get to those in a bit as well, but that'll all be covered in sort of the UK pension bit. But I've got your question there, so I will come back to that there. But we just wanted to give a very sort of high level overview. And again, I think most people are going to be sort of familiar with these terms. I can see a number of you have sort of pensions in both the US and the UK. But of course, with the tax deferred accounts in the US, we're talking about here, like 401ks, the traditional IRAs, SEP IRAs, Benny IRAs. These are the ones where they're going to be tax deferred, meaning that you can grow with it. It's tax deferred in the pension wrapper, but then you start taking pension distribution is going to be taxed at income tax rates. And with the sort of these tax deferred accounts, you also have things like required minimum distributions, or RMDs. These start at age 73. So again, it's just to be aware of that as you sort of approach that age. The point to note here, though, is when US taxpayers are living here in the UK, what we often see is that 10% is actually withheld from the US as standard. And so just as where you'd be working with a US UK tax account to say, look, no, I've already paid some US taxes there, but I need a credit for that when I'm living here in the UK. So just to be aware of those things.
And just to note also that age changes. So if you've heard if you heard at some point in the past that it was 70 or some other number, it was probably true then. So just be aware that is the current number, but it's not fixed.
Exactly that. And again, we'll come onto this for the UK pensions. You can see that when you can start accessing these pensions, in the UK it's increased. We haven't actually got it on the slides here, but in the US you can start accessing your pensions from 59.5. That said, even if you can start accessing them, sometimes it's not always the most sensible thing to do because of the things I was talking about earlier. The fact you can still benefit from the tax deferred growth, you want to leave those pensions to grow for as long as possible. And especially with the next one, sort of the tax-free accounts, or sort of Roth IRAs or Roth 401ks, these are actually tax-free accounts, meaning that where they've been funded with post-tax dollars, it grows tax-free in that account. So there's no income or capital gains taxes when it's in the pension wrapper. And more importantly, when you take distributions from that Roth IRA or 401k Roth, it's also tax-free. So they are a fantastic planning tool for anyone really that has actually got assets in a Roth IRA, and they're not subject to any sort of required minimum distributions like we discussed above. Oh, sorry. I think my ordering's gone slightly wrong on there. My apologies. Because what we wanted to look at here was really talking about sort of the US pensions. As we said, they are still aligned from both the US and the UK. It's just to be aware of, okay, well, who can actually contribute to these pensions? So typically, you need US earned income to be able to get assets into a US pension account, which sort of makes sense. You need to either be sort of earn on a US contract, and you say, well, I've got US taxable income from employment earnings, and I can get that into a pension wrapper. Makes sense. There's also things that you need to be aware of in terms of the contribution limits. We haven't got any of those in the slides today, but they're going to be different for sort of 401ks compared to traditional IRAs. And it's also different for sort of Roth IRAs and who can actually contribute to a Roth. If your income is above sort of $140,000 a year, you can't actually make contributions, but there are some planning opportunities that you can take. But again, we won't go into those today. But if you are in those situations, then get in touch with us. Sorry for this. I did have another slide on there, so I'm
Yeah.
not too sure why that's gone,
Hmm.
actually.
Interesting.
I'm trying to think what else had I on there, because I could just talk around it before actually moving on to the UK pensions. The other one as well is that we get the question of sometimes for individuals that are living here in the UK, but they are earning excess wealth over and above what is called sort of a foreign earned income exclusion, which I'm sure a number of you may be aware of. It's essentially that whole sort of tax regime is that if you are earning a certain threshold, I think it's around $120,000, you don't have to worry about any income earned outside of the US, because it's sort of that foreign income is excluded for the purposes of US taxes. That said, if you earn over this amount, there are ways to actually get assets or sort of funds into a US pension. And so again, there's a lot of technicality around who can actually contribute in what amounts. And so again, we could probably cover these slightly in the next conversation. But it's just to note there, just as a recap of sort of the US pensions, but they're treated as they are in the US, also in the UK.
That's the key part. Yeah.
Exactly that. Now, for the UK pensions, we just wanted to again, we're focusing really just on the occupational personal pensions today. And again, I'm not going to completely just talk at you and just read through this here, but again, in the UK side of things, there's also limits and on who can actually contribute. What is your annual allowance each year? What is the sort of the carry forward of unused allowances? So again, these are all going to be dependent on individuals and what they're actually earning each year. George, I can see you added on something on there.
Yeah, I was just going to say, just to help frame this, as a general rule of thumb, pensions in both places have the same intention, which is to suck money away, let it grow in this tax preferred environment for a long period of time to fund your future retirement, right? So they work in the same way in both places, and generally both countries sort of treat them the same way, et cetera. Generally, the US is probably a bit easier to get money into a pension. The UK has been excluding and reducing thresholds year after year after year for a long time, making it quite a bit harder to get money into a pension and capping how much you can keep into a pension and so forth. So the UK has gotten a bit trickier that way. But on the other hand, there is more flexibility with some of the pension options in terms of what you can do with pensions and distributions and so forth. So there's a little more complex in the UK, a little more flexibility in the UK, but tends to be less amount that you can easily build in the UK pensions, just to frame the two.
Yeah. And you can just see there sort of the tapering of allowances and things like that. But again, this is for high earners and what they can actually get into a pension each year. The point to note in terms of sort of the UK contribution, so you do have that annual allowance of up to $60,000, but that is if you earn $60,000. It's either the max of 60 or up to, and this is amounts that you can contribute to a pension and get tax relief on. So that's the important point to note here. In terms of, and again, this goes back to your point there, Jonathan, in terms of self-invested personal pensions. So this is a type of UK pension. And we often see this where either people have left their employer, so they will be working and they're just contributing to their sort of occupational scheme over time, and they're just in their particular funds, whoever that may be. And then once they've actually left that employer or they've actually come to retire, it often makes sense to actually roll those UK pension funds into what is called a self-invested personal pension. A SIP is what they're referred to as. And the reason for that there's a few reasons to actually make that move. But really, the benefits of a SIP is the fact you have far greater investment choice for the assets that you actually hold within the SIP. And I'll come back to Jonathan why that is important here and some of the pension providers that we work with. So again, you can hold a number of different, so whether it's cash, fixed income, if you want funds, you can have a sort of commercial property, a number of different sort of investments held within that SIP wrapper. And what that includes, and where we often see this for, again, our sort of cohort, is it also gives you the flexibility about where the underlying assets are held. So we work with a few pension providers here in the UK that importantly allow the underlying custody of those assets to be in the US. Now, where this gets extremely sort of beneficial is, say, for example, you've lived in the UK your whole life. You've contributed to your UK pension over time, and you say, do you know what? I actually want to retire back to the US. Working with a pension provider that we work with, they actually allow the underlying custody to be in the US, in US funds. Our investments are actually globally diversified, but they're in US funds denominated in dollars, which of course is important because then that aligns to your spending currency, which is a really, really sort of important point to note there. And so, Jonathan, just going back to your point there, so are there pension administrators that can have assets in dollars rather than sterling? The answer is yes. But typically you have to work with a firm like MASECO where they're actually registered. We're registered with the SEC in the States, so we can advise in that jurisdiction. But we're also registered in the UK by the FCA, so we can actually advise here on UK products. So that's just a point to note there. The other point to note with SIPs as well is the fact you have, well, that transfer that I just spoke about there. So again, we won't, I'll define some terms here, but if you are making a transfer from what is a defined contribution scheme, i.e. you are the employee, you're just contributing to this account, the employer may just also contribute to it. That transfer from a defined contribution scheme to a SIP is not a, you don't have to undertake sort of regulated advice to do so. Whereas for a defined benefit scheme, which you don't see too often anymore, but this is sort of, it used to be called sort of final salary schemes where the actual employer would say, you've built all these pension assets and we're going to pay you X amount each year in your retirement. Quite expensive for the firms, which is probably why we don't see them too often anymore. But that is an example of you need to get regulated advice and an actual pension transfer analysis done on that. But people will often do that where they are moving back to the US as an example, and they want to get that increased flexibility about how you invest the underlying investments.
I'll do those in a second. I see those in this. Finish what you're doing first, and then I'll come back to Greg's questions and Jonathan's.
Perfect. And just in terms of the SIPs as well, in terms of the sort of the other the benefits, is really how you actually start to access the pensions. Whether or not you take sort of an annuity, whether you look at sort of flexi access drawdown, which is what we most often come across, is sort of someone might take their 25% tax-free lump sum, which we'll come on to in a moment, and then just have the rest of the pension in drawdown, and they just take the money out and just pay taxes on that. You have sort of phased retirement, or the sort of what is known as sort of the uncrystallized fund pension lump sum, where you take either the full amount out and just pay sort of the taxes on the full amount, or you take out portions and pay only you get 25% of each portion is tax-free, but then the rest is taxed. 75% is taxed as income taxes. The whole point here is that you've got a lot of flexibility about how you actually start to access your UK pension savings within a SIP, which is fantastic, and another reason why people use them. I'll just finish this last point on here, because again, this relates to your first one there, Jonathan, in terms of pensions being considered trusts or foreign trusts from a US perspective. Now, you are right. There are some tax accountants out there. We know who they are. There's not many, but they will look at a SIP and consider it a foreign trust, and therefore things like the underlying assets within that trust, if they are considered non-US funds, which is often the case. If you're here in the UK and you want to invest in sort of funds that are denominated in GBP to align to your spending currency, some tax accountants may look at actually the reporting, consider those passive foreign investment companies, which is what we covered in the last session, can get pretty costly in terms of the tax costs and the filing and things like that. So just something to be aware of there. But again, that is only the vast majority of US UK accountants will consider sort of pensions in both jurisdictions. But it's an important point to note, to just be aware that, again, like so many of these things, it's a little bit of a gray area. And
so just to be clear, Jonathan, both of your questions are linked to each other, and they are both a reflection of a viewpoint about pensions that is not universally held, and it's a minority viewpoint. Because it's not explicitly written in the tax treaty, it's possible to have differences in the viewpoints of the tax professionals, and that viewpoint about FBARs and trusts, pensions as trusts, and therefore PFIC implications, all of that is part of the same stream of a particular point of view that is not universal, but we do know it is out there.
Exactly. And just to cover your point there, Jonathan, so in terms of yes, to file any foreign account that you hold, regardless of pension or otherwise bank accounts, you have to file that on an FBAR. The other form you're referring to there is called a 3520 form. And again, this is just an annual filing requirement for some tax accountants will request this when you have SIP assets. And really, it just covers sort of high-level information, looking at what is the maximum balance in the year, if there's been additions, there have been contributions or withdrawals, looking at things like along those lines. And so, yes, 3520 is the tax form you're referring to there. But again, that's if you're working with sort of a UK tax accountant, it'll be dependent on whether they're actually requesting it.
As you flip to the next slide, I'm going to answer Greg's question. So, Greg, your second question is the easiest one, which is consolidating company-sponsored pensions into a SIP is something we see people do all the time. As you note in your question, it's something you can only do with pensions you're no longer actively contributing to. So your last 2 or 3 or 4 employers, you might still have a bunch of old pensions sitting around those, and consolidating those into a SIP is something that we see people do all the time. We help people do all the time. But if you're still actively contributing to an active pension, you can't use that roll up with that stays separate because you're still contributing to it. The question about stuffing your employee sponsored pension, I love that term. So I don't know that we have really gotten into it, but the third bullet point on the slide there talks about the carry forward allowance, and you're making reference to that. So for that to work, you would have had to have had a pension in place already. So you can't just create one now and then go back a bunch of years and do the carry forward. You would have had to have had one in place in those prior years, not been fully funding it, and then that excess that you didn't fund, you can then go and make up the funding for. So if that is the case, then yes, there might be some potential to take advantage of that. But again, there's a cash and cash flow issue there for a lot of people be able to actually take advantage of that strategy. But yes, it's potentially possible to do exactly that. That's part of the point that Dan was trying to make, I think.
Yep. And I'm conscious we've got 10 minutes left.
Sorry, go ahead. Sorry, and just at the very bottom, and no, there aren't tax implications in the US UK for consolidated pensions. So if you're consolidating a bunch of dormant pensions, no, there's no tax implication.
Yeah, and the important point to note there is because it's moving from one qualifying plan directly into another. You're not actually taking the distribution.
Yeah, that's the key. Yeah. Okay.
And again, we want to make sure that we're covering these. But again, if we have any other questions specifically about sort of the use of foreign tax credits, because again, from a US perspective, getting contributions into a UK pension, you may not actually receive that tax relief in the US. And the point we're making here is this is often a time where you can sort of use excess foreign tax credits, which most people are going to be generating just because of the differences in the US and UK tax rates. Of course, in the UK, you start paying 45% as sort of over £125,000. In the US, you need to be earning like $400 and something thousand before you start hitting that higher banding. And so people that are actually living here and employed on a UK contract and getting paid in sterling are often paying more taxes and are starting generating these excess foreign tax credits. So we're just making a point to note there that this can sometimes be used to offset some of those taxable pension contributions in the US. And again, it'd be working with a tax accountant to understand what your excess foreign tax credit position is.
We're almost
again,
through.
we don't want to sort of labour this. We don't want to labour this too much in terms of the sort of accessing UK pensions, but very, very high level. So again, as we said, these ages are always changing. So it was 55, well, it is currently to access a UK pension. That increases to 57 in April 2028. Now, as we sit here talking to you guys, a UK pension is actually held outside of your UK inherited estate. That said, as of the budget, what was that, a month and a bit ago now, there was some legislation changes with how UK pensions would actually form part of one's inherited estate. Doesn't happen until sort of April 2027. But again, now we won't focus on it now, but there'll just have to be new planning measures put in place for individuals, whether or not you take the tax-free lump sum out and you gift that in your lifetime. Again, these are all conversations we'll be having sort of as we approach that date. in terms of sort of death before age 75, there's going to be tax exempt to beneficiaries. Death after that is going to be taxed at the beneficiary's marginal rate. This was something that they are having sort of further talks about in government, because it's almost hit, if you're going to get your pension is going to be part of your inherited estate and get taxed at 40%, and then your beneficiaries, if you was to die and you're over age 75, and then they're getting hit with a marginal income tax rate that overall starts getting pretty high. And so I think there's going to be some sort of further consultation there. But what I want to just make sure we finish on for the UK pensions is just how things like the tax-free lump sum is viewed from a US UK perspective, but also then going back to, okay, if I was to move back to the US, are there any planning opportunities that we can take? And so I just want to make sure we cover both of those off before we finish. But a tax-free lump sum, again, unfortunately, it's a little bit of a grey area, as we keep saying that. I know it's a bit of a buzzword at the minute, but in the UK, that's always going to be considered sort of, you can get your pension assets, you can take up to 25% of that and receive that as a tax-free lump sum, which is great. The amount of which you can take is capped essentially, and you can see that figure there for the lifetime savings allowance of 268,275, which is essentially 25% of what was the old lifetime allowance, is the figure there, just of the lifetime savings bit. The important point to note here is how does the US treat this? And again, unfortunately, is going to be completely dependent on which tax advisor you talk to, which state, if you're back in the US, which state you are then living in. And it's really, and we won't go into the sort of the technicalities, but there's essentially an article in the US UK tax treaty which looks at how these pension distributions are viewed. And essentially people will take different viewpoints. So that's just a point to note there. But I did want to just finish on terms of sort of retiring to the US, because there's a little bit of planning that that individual should take, but you need to know how to do it before you actually go ahead and actually start taking your pension distributions. And so for anyone that is moving back to the US and you have UK pension assets, what you can do is actually essentially elect by filing in 2 of these forms I've just got listed on there to say, look, I'm no longer a UK tax resident. And so what you can then do is apply for sort of a nil tax code is what it's called. But the benefit of that is you can receive pension distributions gross from a UK perspective. Now, as we said, in the UK, you're going to be paying the higher rates of taxes pretty early. And so if you can receive pension distributions gross, you don't pay any UK taxes, and then you just pay your US income taxes as you receive that money. And so you can actually have some pretty good tax savings there by going through this process. But for anyone that is actually nearing the stage of actually having to take distributions from your pension, the planning is usually to take a small distribution from the pension, because then you can apply for sort of these different applications for US resident certification. You can do the double tax treaty, but you need to have your pension in distribution. And so what we often see is to take, say, like £500 worth of a distribution, then go through this process, which, just to be warned, it can take a few months. You've got to get the IRS and HMRC involved, so it's never usually a quick process. So the early you sort of start that, the better. But again, just wanted to just make sure we'd cover that today.
I just think that these last 2 points on these last 2 slides,
yeah,
hopefully the key that should be clear in this is it's about planning. So if you wait to the last second and haven't thought ahead, then you're going to start to restrict what you could have done or should have done. So this is an area where, you know you're going to be stopping working at some point. You know you're going to move or not move at some point. This is not something that's just going to happen to you. So in the process where you start to think about those things, starting to plan ahead and start to see exactly how this applies and how that might shape your plans is really, really the key there.
Exactly that. Conscious we've only given you 3 minutes for questions.
We've been
But
doing
as I said,
the whole time.
I know. Is there any? Yeah, we have actually. Is there any other ones that people want to just fire into the chat now, or Todd? I don't know if they're able to come off mute and just ask them live, or.
While that's happening, I will say that last comment I made is also an advertisement for the next session, which is going to be all about planning.
Yes.
So if you're thinking about, hey, what does that mean to me? And you're not in your 20s and 30s still in just wealth building mode, and you are instead nearing the decumulation phase instead of accumulation phase in your pensions, then you definitely want to be joining those planning sessions. But I'll get Todd back online to
Yeah.
Question.
Yes. I've allowed participants to unmute, so they're welcome to pop up any questions in the last 2 minutes. And I will say that is a great advertisement for the next session, which everyone save the date for, I believe it's Wednesday, January 29th. We'll be
You
hosting
are
it.
right there.
Thank you. Perfect. We'll be hosting it in person, and you will get registration details, not now, but in due course. We'll make sure everyone gets registration details and everyone can sign up.
I'll just add to, parenthetically, Dan made a comment about a third of the way through about remittance and terms like this, and there had been changes and things would be changing and so forth. There are changes that have just happened around UK pensions that we didn't try and go through now. All of this has to do with the most recent UK budget that came out. One of the things we had meant to share with Todd, and we'll do after this in advance of the January session, is just a simple podcast and a simple webinar we've done, and sort of normal language like this about some of the more recent changes on that topic, on those topics, so you can be aware. And when we do the in-person planning session, we can also talk about how some of those things might impact any of you as you're starting to think about planning. So we'll link it in there.
Brilliant. I will share those around with the group, and I will also share a recording of tonight's session and the last session and the registration link for the 29th of January. And any final questions before we let everyone go for the evening? Maybe. All right. Well,
don't be shy. No questions.
I was going to say, yeah,
we field questions all the time. It's not a big deal. Just get in touch if you have any questions, and otherwise, have a great dinner and see everybody in person sometime.
Yeah. Take care, guys.
thanks everyone. Have a great night.
Bye. You too. Bye.